Our next speaker is Michael Azlen. Michael is founder and CEO of Carbon Cap Management. He's 25 years experience as a senior investment professional, and Michael's focused his research on climate change and impact investment strategies. Michael, it's all yours.
Great. Thank you very much, David, and thanks to Peter for having me on today. I'm going to be speaking today mainly about the regulated and the liquid compliance carbon markets that are run by governments. And hopefully today will be a quick educational tour on how regulated carbon markets actually function and the differences between regulated carbon markets and the voluntary carbon market. The big picture, of course, I think we're all up to speed on. We're trying to solve for an equation of how can we reduce emissions at maximum velocity. We've warmed the planet by about 1.1 degrees since pre-industrial times. The Paris Agreement has set us thresholds of 1.5 to 2 degrees. So at our current run rate, and to be clear, we will emit 40 gigatons, 40 billion tons this year, notwithstanding the huge efforts that are being made and that we read about in the press. We will emit 40 billion tons. And therefore, the ppm concentration of carbon dioxide in our atmosphere will climb this year, it will climb next year, and it will continue to climb. So we are trying to solve for an equation that at current run rate emissions, we will breach 1.5 degrees in 8 to 10 years. And when we do that, as one of the other panelists mentioned, we trigger positive feedbacks where the planet itself moves from being a net sequesterer of carbon into a net emitter of carbon. And of course, that can then invoke runaway climate change. So we have a very, very serious situation to deal with in terms of climate change. Today, I'm going to share a few slides. Hopefully, these work. So if you guys can tell me if you can see these, I would appreciate them. My background is in the investment management world. I did my graduate degree at London Business School. I've been teaching on the graduate degree program now for 18 years, and I teach a segment on the impact of climate change for asset managers and asset owners, which is a very fast-moving area. After building and selling my previous asset management business to a Swiss public company, I had an earnout period and some time out, and that is when I became deeply involved in climate change research. And initially, that was the science of climate change. And I've now read more than 200 academic papers and more than 30 books on the topic in the last 4 or 5 years. In 2018, at the LSE, they have a economics and governance climate change high-level program, and that is where I learned about carbon markets as a policy tool to address climate change, but also as a liquid and investable asset class. We have combined this by putting out a piece of thought leadership research on carbon as a liquid and investable asset class. And over 2 years ago, we launched the World Carbon Fund. It's a climate change impact fund that has dual objectives. The first objective is, of course, to generate returns, risk-adjusted returns at a low correlation for our investors, but it also has an objective to have a direct impact on climate change. And there are a number of impacts, but the hardest is 20% of the performance fees for that fund are used to purchase carbon, mainly in the compliance markets, although we have not ruled out the voluntary carbon market, and to then cancel that carbon. So there's a direct alignment between us as the manager, our investors, and the performance of the fund, which is a really nice alignment for climate change. Over the 2 years we've been running the fund has generated a return of over 70%. So it's been a very strong period of performance, and the fund has just passed $100 million under management with a recent addition of a well-known U.S. institution who's dipped their toe in the water. So that gives you a little bit of background on myself and the company. I think I just want to keep it relatively high level in terms of we're talking about carbon markets, of course, and globally, we do live in a market-based economy. So even in China, of course, they've embraced market-based capitalism, not for everything, of course, but for many of the markets. And therefore, as this statement says, putting a price on emissions really does move the needle because businesses and governments react to that pricing. So that price signal is very, very important. And you can see on this chart from the World Bank, with the launch last year, you can see the yellow bar here of the Chinese carbon market. It covers over 4 billion tons of annual emissions. We now have about 24% of emissions on the planet that are covered by some kind of price. What I'd like to do is first outline the key 5 bullet points. And if you're unfamiliar with the difference between compliance and voluntary carbon, please write down these points because I think this is very, very important to understand. So the first thing is when we're talking about the voluntary carbon market, this is project-based. You plant trees, you calculate the amount of carbon that will be sequestered by the trees or mangrove swamps of blue carbon projects, these kind of project-related emission reductions. That market, and I believe the market is crucially important, the voluntary market, so please don't take my comments out of context, but objectively speaking, there are 5 key things people need to understand about the voluntary market. The first is it is an unregulated market. It is not regulated by any financial watchdog or oversight. Second, although there are some now efforts by Bill Pazos and others to bring liquidity, there are a few products. It is generally an illiquid market. It is, we've heard from speakers, it's growing quickly. The size last year, about $1 billion. This is approximately 1,000 times smaller than the regulated and liquid carbon markets. So it's growing quickly, but we need to keep in perspective the size, the pricing, and other factors. The fourth point is the complexity and opaqueness within the market and the whole variety of standards, which make it very difficult for people to understand. And fifth, and I think this is a very important point, in the voluntary market, we have effectively an unlimited supply of carbon credits and offsets. Unlimited. More projects and more projects. And I can tell you as the manager of the World Carbon Fund, I receive many, many emails on many, many projects. And to me, most of the projects that I receive in any event really are of low quality. Now let's go through the same 5 bullets for the regulated carbon markets. First point, they are regulated and run by governments. Second, very liquid. We're now trading $3 to $5 billion daily in these markets. Third, large size. Last year, about $1 trillion traded in these markets. Fourth, very transparent. The government discloses the supply of permits and how the calculations are done in terms of auctioning the supply and the free allocation. And number 5, very important, the supply of carbon permits is capped and it reduces every year. The supply is capped and it reduces every year. Very, very different to understand these 2 markets. So let's go through here on the slide how a compliance market works. And I'm speaking very quickly because of the limited time. So the objective of a compliance carbon market is twofold. One, to cap and lower emissions. But number 2, to achieve that objective at the lowest possible cost to society. That second objective is very important and often is glossed over. You have mandatory inclusion. Usually for any company or factory that emits more than 25,000 tons per year, you are notified by the government. You don't have an option, you are included. If you're included, it means you're audited by the government. And you must submit permits, not credits and not offsets. You must submit allowance permits to the government the year after. Because the penalties are severe, we have 100% compliance. These permits are mainly sold at auctions. In Europe, we have auctions every day. In California and the RGGI carbon markets in the US, there's auctions every quarter. And in the United Kingdom, for example, these permits are sold at auctions every 2 weeks. The total supply that is sold by the government, of course, is capped, and that supply is reduced every year. This achieves the first environmental objective. We know that because we reduce the supply of permits, we know that someone within the ecosystem, some or multiple of those players, they must reduce emissions. So our first objective has been achieved. What we don't know is which entity will choose to reduce their emissions. And this is where we harness the power of the market to achieve our environmental objectives. And I think this is really the powerful part of the carbon market. Entities buy and sell carbon, creating a secondary and liquid market. That creates the price. So the government controls the quantity of emissions, but it allows the market to determine the price. That price signal is then internalized by those thousands of companies where they calculate at what price does it make sense for me as a company to invest in new technology and to lower my carbon emissions. So it's internalized, and that stimulates what we call as least cost abatement. What we want is to achieve that second objective. We want to cap and lower emissions, but at the lowest possible cost to society. The liquid market in carbon also allows companies to hedge their carbon obligations multi-years into the future, and that's also an advantage. And most of the revenue from the auctioning of the permits is segregated by the government and reinvested into low carbon and energy efficiency initiatives. So when you step back from this mechanism, and it did take me quite a bit of time to study and look at the success of this system, it is really an elegant and scalable solution to address climate change in the time that we have remaining, I believe. If we think about abatement costs in any society or any country, each bar on this graph represents a different industrial process that emits carbon. And of course, for some processes, you have the price of carbon per ton here. For some processes, they're very inexpensive, but other industrial processes are quite costly. And therefore, this is the least cost abatement. What we want to do is we want the low-hanging fruit here. We want these companies to abate first, and we unlock each element of abatement within our economy from left to right. This is a very, very famous graph in environmental economics called a marginal abatement cost curve. The proof is really in the pudding. And since the carbon market was launched in Europe in 2005, off the back of the success of the sulfur dioxide market in the United States, emissions in Europe are down 1 billion metric tons per year. Now, those reductions are not only due to the carbon market. There have been multiple factors, technology improvements, overlapping regulatory policies, but certainly having a price on emissions has stimulated a significant amount of innovation, technology, and abatement activity. I'm very pleased to say that off the back of that success and more countries now making Paris Agreement pledges, that the adoption of a regulated compliance carbon market globally is really, really gathering steam. Only today, ICAP released their update report, and I was amazed by the number of initiatives all around the world. And just to take you through that, today we are invested in the World Carbon Fund in 5 carbon markets. Just quickly go through that. The European market, of course, the UK launched their own carbon market after Brexit last year. In the United States, we have 2 carbon markets. You have the California market linked with Quebec. It's called the Western Climate Initiative. Interesting, Washington State is now passing legislation to launch its own carbon market and probably link with California. Oregon, something similar is being developed. On the East Coast of the US, you've got the Regional Greenhouse Gas Initiative. This is 11 US states, with New Jersey joining in 2020, Virginia joined last year, and Pennsylvania is scheduled to join this year. If Pennsylvania does indeed join, the market will double in size. The 5th market we invested in is New Zealand. This is a small carbon market, but quite old, very robust, and the government has high levels of climate ambition, which we really like. The big news, of course, is China. After running 8 pilot markets, regionally carbon markets for 8 years, China launched last year their national emission trading system covering over 4 billion tons of emissions. So if you think about how do we address climate change at scale, if you were to reduce that 4 billion by 2.5% per year, which is a typical rate of reduction in a carbon market, that's 100 million tons per year, which is effectively the emissions of the United Kingdom being taken out of the system. So you can see why it excites me to see more coverage of these carbon markets, because we do have an urgent need to reduce emissions at scale, but also at the lowest possible cost. So we, after completing the program at the LSE and learning about carbon markets, my first question was, well, perhaps this is a good investment also for me in my personal portfolio. It's liquid, it's investable, and we need higher carbon prices. I searched for statistical data on this asset class and found there was none. So I hired a PhD student from the LSE, and we put together a full academic paper on carbon called the Carbon Risk Premium. That has been now published by the CFA Institute as a case study. And what we found in that research is that carbon in the last 9 years, and this is slightly out of date, has been appreciating at about 25% a year with quite high volatility, but very low correlation to all other assets. And that, of course, really intrigued me, because we're all searching for asset classes with a positive rate of return and a very low correlation. I'll skip these slides and really talk about the big picture for where carbon prices need to be consistent with the Paris Agreement objectives. So that temperature threshold under Paris, 1.5 and 2 degrees, because we understand the transient climate response to emissions, we can translate that temperature budget into an emissions budget. And therefore, we can then look at that marginal abatement cost curve and ask an important question. What is the carbon price we need by 2030 to achieve the Paris Agreement objectives? And I've listed 4 very well-respected studies here that indicate we need about $113 a ton. So today, the carbon price is $60 or $70 a ton. In the compliance markets, I think one of the speakers before mentioned that the price last year in voluntary carbon was about $4 a ton. Again, I would say, instantly, what does that conjure in terms of your understanding of the underlying veracity and quality? $4 a ton versus the current mark in the government regulated market, $60 or $70 per ton. So that we believe that, buying at 60 or 70, and if the market gets to 100 or 120, you're looking at a perhaps 5 to 7% annualized rate of return. That's quite attractive. We in the World Carbon Fund, just very quickly, we have these dual objectives, so generate return and also have an impact on climate change. We're investing in multiple of these markets today. We've built a very, very experienced team, both in carbon policy, carbon markets, and of course, portfolio management. The markets are large and liquid. I mentioned our track record now, just past 2 years, we just passed 100 million, and the fund is up about 70% over that time. That's a brief picture of the track record. Interesting, you can see on this graph the monthly value traded in these markets was around $30 billion a month, and towards the end of last year we were up to $80 billion per month. So the liquidity in these markets is growing significantly. That really was a very, very quick run through. We have lots of educational materials on our website about carbon pricing, about emissions trading. There are webinars. I'm a regular speaker on webinars and podcasts. There's a couple of those that are listed on our website, and I would encourage people, if you have an interest in educating yourself on this, please go to the website or please get in touch if you're interested in the fund. And happy to take some questions now.
That's great. Thanks, Michael. That was an incredible analysis of carbon pricing. I think it was a great use of, well, it seemed we've gotten a lot of comments that it was a great use of policy and research. So I'm really appreciative of the insights. Maybe we can have one question here quickly in the minute that we have left. But one of the attendees says, I understand that voluntary carbon markets can participate up to a certain extent. maybe 10% in compliance markets, depending on jurisdiction, like ETS mechanisms. Is there any specific qualifying criteria or exclusive channels for high quality voluntary credits to participate in the compliance market?
Yeah. So, in Carbon Markets 1.0 in the European market, one of the learnings that happened there was in allowing voluntary carbon credits and offsets to be fungible within the regulated compliance markets. And that stimulated a huge amount of development of carbon offsets and credits, which flooded the European market. I mean, I wouldn't say flooded because they were limited to a certain percentage, but it was one of the reasons that was pointed at. There was a big arbitrage between the 30 euro price at the time, 25 to 30 euro price, and the cost of producing those projects in the small single-digit dollars. So it really generated, and that was a good thing from generating project development, but it did contribute to the collapse in prices. And in Europe, they decided to phase that out and really just stick to the actual permits. Now, in other markets, like in China, for instance, they've already said they're going to allow up to 5% of your compliance obligation to be met with Chinese-approved voluntary carbon project-related credits. And in California, also, there's a couple of percent of your obligation. You have to turn in permits. You can use some of the California-approved voluntary credits. But as a general rule, most of it's run by you have to submit the actual allowance permits.
That's great. Well, thanks. We are up against the end of this time, but Michael, thanks again. That was exceptional. If people have other questions for Michael, feel free to send them over afterwards, and Michael can field them that way. And again, Michael, thanks. Appreciate it.
My pleasure.